Today, we're joined by Cliff Booth, founder and chairman of Westmount Realty Capital, a Dallas-based investment firm with a national footprint and a track record spanning more than 4 decades. Westmount has acquired and managed over $2.5 billion in assets across multifamily, industrial, and office, and is known for its hands-on, value-add approach and ability to spot opportunities others might overlook. Cliff's been in the business for over 40 years, leading through multiple market cycles. We talk about how he got his start in the business, his perspective on the current market, and where he's finding opportunities across asset types. So with that, let's get into it. Cliff, thanks for coming on.
Pleasure.
Yeah,
thanks for having me.
This is great. You have such an interesting story. We're both Dallas people. I've seen the name
Jack,
West.
Stop bragging.
Oh, what?
He just got here.
Oh, you're right. Sorry. I'll take it easy.
Peanut.
You're a Dallas person, and
Yeah,
I'm a Dallas person too.
Good
Okay.
job.
And Westmount is a name that I see and have seen for quite some time in the multifamily space, industrial space. I know you're in other spaces too, but those are what I predominantly, I think, know you guys from. You have an interesting story. So let's take it from the beginning, if you don't mind, because I know you're not a Dallas native, but have kind of called Dallas your home and made it something special.
Yeah. Well, great. Thanks for having me here, guys. So the Westmount name, since we're talking about original places, comes from Montreal, where I'm originally from. Montreal is an island. The mountain in the middle of the city is called Westmount. My family's business was in Westmount, so that's how it was kind of tip of the hat to where I'm from. And we have still many investors. And originally, as we got going over 40 years ago, there were a number of people from Montreal who helped us to get going, and still very loyal and faithful to them, and very appreciative. So that's where we got the name from.
Who are these people? Are these friends, family, or
friends, family? Yes. In addition to other people in the community that I got connected with, one way or the other.
Okay.
And a number of them actually real estate people.
Okay, well, that makes sense. You ended up moving to Dallas and calling Dallas home, and you have an interesting story in terms of your first real estate project. Do you mind kind of sharing that story with us? You might get tired of telling the story.
Yeah. So the background is that my family was in the antiques and art business in Montreal. I was third generation in that business. In the late 70s, there was political turmoil in Quebec, where Montreal is. We decided to relocate our business to Texas. That's a whole other story in itself, related to socialized medicine and doctors who left Canada to go to the U.S. That's how we even got connected to Dallas. So we decided to move our business, and we did in 1979, bought a piece of real estate in Dallas, which is now across the street from the Crescent. The Crescent did not exist at that time, but there were a lot of antique stores and galleries around that area on Maple Avenue. So I found that building. We bought and renovated this property. It's called the Hotel Saint-Germain now.
By the way, it just closed. Do you know this?
I saw that it was under renovation. I didn't think it closed.
I think it's getting redeveloped. I think they're building. Last I read, there was just a notification that they're going to be building a massive mixed-use project over it.
Oh, seriously?
So,
I did not know that.
Yeah.
I wanted to stay there not that long ago, and they called me back and said, no, we're under renovation. But maybe your information is...
It's a beautiful hotel, though.
It's a beautiful building,
property.
a big Victorian mansion. We actually won an award for renovating it, and then eventually sold it.
Wow.
So, and we were in the antique and art business, operating out of that beautiful building for a few years. And it didn't go that great in Dallas, but there were a number of reasons for that, including that was when interest rates went high, luxury business, and high interest rates don't usually go that well. Early 80s, Reagan, all that, stuff that was going on. So after we sold that building, I looked at myself and my father and I said, I don't know, I'm not a rocket scientist, but I worked really hard for a few years in the antique business, don't have much to show for it, and did one real estate deal. and had something to show for it at a young age. It was a significant amount of money for me, and that's how I launched my real estate career.
So for the poor folks like Alex who don't know much about Dallas,
Please.
The Crescent and that area has blown up. I mean, that uptown area is what they're also calling Y'all Street now, which we can debate about here and there. But how did you know that? I mean, how much of this was sheer luck, and how much of this was you doing some real research on where's a good piece of real estate to buy?
Oh, well, I mean, there was.
I'm sure you've thought about this.
There was no market study, I can tell you that. It wasn't really complicated for us in terms of buying a building to house our antiques and art business because it was.
That's where they were.
That's where all the galleries were. It was close to McKinney Avenue, downtown. It was easy to get to. A new paragraph. There was no way to know that they were going to build the Crescent right across the street.
Yeah.
So, I mean, that was...
And they thought they were crazy, right? When the Crescent was coming up, everyone thought this was going to be...
the largest hole, I think, I don't know, maybe still, for sure in Dallas, maybe in other places. I think it's 11 acres or something like that, and they went down half a dozen floors. It took them a year just to dig the hole, I think, or maybe 2 years to build that garage. Yeah, it's still today, a landmark project in Dallas, in my view.
No, it really is. It single-handedly almost pretty much redeveloped or repurposed Uptown.
So you guys bought this building. Antique business kind of takes the high road. What do you and your dad decide to do next?
So I helped my dad sell off the rest of his antique inventory, and then he moved on to do some other things. And I started buying real estate. A small apartment building, a small warehouse, a piece of land, a shopping center, and just kind of...
Okay, we got to take a step back because here's where it gets interesting to me. You have people who for years try to get into real estate, try to get into syndication. They're trying to put deals together. They're taking underwriting courses. They're taking courses on how to invest in yada, yada, yada. How is it you went from that without really a prior real estate background, it seems like, to kind of figuring it out as you go, it sounds like, into getting into multifamily and then later industrial?
So I did go take some real estate classes and got my my license, right?
Okay.
So to learn sort of the basics, how to write a contract and what easements and surveys and title policies were. So you're right, I didn't know a lot, but then we owned this property, and so I learned how to some of the basics, and my family I didn't mention, but they were sort of modest real estate investors in Canada.
Got it.
So I had some exposure to it, but yeah, being in Dallas at that time was a very exciting time to enter the real estate business. It got pretty nasty pretty quickly with the 1986 tax reform bill and the crash of the savings and loans. Sort of good news, bad news for me. It was probably an opportunity because, being a local guy, Jack, you'll relate to this possibly. The fact that I didn't go to SMU or any local university, I wasn't really plugged in. So I didn't have the same access to capital, even debt, right, that local people do. Also coming from Canada, where it was more conservative, I didn't understand the concept really of how do you go buy a piece of real estate and not write a check, without
leverage and
people were borrowing money from SNLs at getting 100% of the money and non-recourse, and there's all these stories about the boat in the marina that says first draw on it. A lot of jokes in Dallas about those times. It ended up to be a really tough time for all the biggest people either went down or they say were walking dead men. But as it started to unfold, it was an amazing opportunity, which we were able to take advantage of by buying distressed real estate from failed institutions, from the government itself, by various banks. And
so was this through the RTC?
RTC,
mostly? Okay.
Yeah. So we bought a lot from that at that time. That I would say that really kickstarted my career. And it was with private investors. At that time, we were not connected with institutional investors. We were for debt. But even at the beginning on those transactions, there was no debt. Everything was all cash. Then there started to be, I remember even the first couple of deals we did, well, they were either seller financed by the government or the institution that was selling the asset that, that they had foreclosed on, or, all cash. And so, but eventually it started to sort of, liquefy. But it was a great run. And we used to joke that, if you were buying something in the industrial front, more than, we'd say if it started with a 2, and we meant more than $20 a foot. Right. So something was 21 or 22 bucks a foot. It was like, what are you, crazy?
Right.
We're not paying $22 a foot. We had been paying 10 and 12 and 15.
Crazy.
Marketing is an essential part of landing financing, but creating lender-ready materials can be time-consuming and hold up deals. Stop spending so much time building deal books with Lev Memo. Lev Memo uses AI to create clean, lender-ready deal documents based on the information you already have. You can generate a memo in minutes and send it out right away as a PDF or virtual deal room. No copy-pasting or formatting required. And now, for the first time ever, Lev Memo is available as a standalone tool, so you can use it without being a full Lev platform user. Plus, it has added capability to support investment sales teams. Learn more at lev.com/memo. That's lev.com/memo.
Crazy. And I, likewise, I guess with multifamily, I mean, tell us, like, what were you picking up multifamily deals for per unit at that time? 20 a door? Less? 50?
Yeah.
I mean, this is, for those that don't know, I mean, these same properties are now trading for 125 a door.
Exactly. Yeah. It was crazy. Office buildings at, 20 and $40 a foot. And,
Wow.
Yeah. It was, we bought, I don't know, maybe 10 million square feet or something like that. It was, It was great. And so, I haven't seen anything like that since then. I'm not sure we will. But,
and what was your thesis early on? As you're buying properties, were you looking for high NOI growth? Were you looking for just good, stable buildings that are fully leased?
They weren't.
Did you guys have a preference to what you did?
No. We were looking for the fundamentals to be good, right? You typically were not buying a great rent roll. The information that you got from these failed institutions from the government was quite poor.
So you're taking a risk.
You were taking a lot of risk.
Were you nervous at the time, or
me and all of our investors? I mean, there were such crazy stories where I remember walking into one building, an office building somewhere off at Trinity Mills in Dallas. We didn't end up buying it, but we walked in, and there was a tenant space that we walked into, and there was a wall. He had literally taken a sledgehammer and just smashed the wall and taken over the space next door. And we started talking to the guy, and he says, listen, I've been trying for months to talk to the owner of the property, to talk to the government. I need more space. And nobody could respond to me. So I said, I'm willing to pay for it. So I just broke the wall.
Yeah. And that just shows you it sounds like the owner or asset manager was just checked out at that time.
Nobody could make a decision, and nobody had money to pay for the TI or the committee. It was the Wild West.
Wow.
So you didn't even know if you got a box, where are the leases? Oh, they're in that box over there. Mm-hmm. Are the people going to stand behind those leases? Were they real? What was lost in that box? I mean, yes, there was a lot of risk. So that's also why you couldn't get debt.
Right. Operationally, these seemed like they were pretty intensive projects, though. I mean, so you'd buy a multifamily property or an industrial property, and you really sounds like you had to put a lot of TLC into it and get dirty. That's what it sounds like.
So it was risky. You didn't know what you had, but there was this belief that you were buying at a price which you needed to buy at that price to justify the work and the risk, that you could come out, especially, let's say, a multifamily. Right, we bought some multifamily. We definitely bought a lot more industrial. We bought a little bit of office, and we bought a little bit of retail, but most of it was industrial. And it was, CapEx was challenged. You didn't know what you were getting. And you just kind of, tried to be logical and practical. and make deals. And what you did find, especially on the, I would say, an industrial and the multifamily, where there was some vibrancy in the market, there was people who wanted the spaces, even in office. Now, we tend to think of office now as a bit more challenged since COVID, and it was always took more and more TIs, but it was still, there was a vibrancy there. But in the industrial and multifamily, for sure, you just kind of rolled up your sleeve. You did what you're supposed to do by being good landlords, and after a while, it did start to turn around. So yeah, all those deals turned out to be really great.
Fundamentally, Dallas is such a sprawling land, and as you both know, there's not a ton of restriction to what you could build. At the time when you really started to scale the portfolio, how did you know what was a good area, or what stuck out to you about a certain location being the right location?
Yeah, I would say that was not that hard. I mean, you could see where, in Dallas especially, it's quite easy to see where growth is going, where even in those days where we didn't have reports and demographics and everything else, you could still sort of feel where action was.
Do you think that trope exists today? Like, it's still easy to see what the path of development is in Dallas?
There's a lot of stereotypes about Dallas, that it's good north and not so good south. We've actually invested a fair amount south of Dallas and done well, and others have as well. There's a lot more activity in the south than there used to be. Having said that, I think some of those things, unfortunately, some of those wrong and sometimes dangerous impressions still remain.
Yeah, going north for south and so forth.
Well, I mean, you look at now, I don't even know where it stops. I mean,
no, it doesn't. It
Sherman,
just keeps going all the way up to Oklahoma.
Yeah, exactly. Yeah, big developments on Lake Texoma, and but also south. If you look at some of the large land acquisitions and the data, facilities that have gone in south in Dallas. The other thing, though, that those acquisitions took us to other markets too. That was what really, I remember one of the first deals it wasn't, but with the RTC, there was a package that took us to a bunch of other markets. So that was kind of, when you talk about how did we grow, you kind of inferred that question earlier. Yep. That was one of the things that took us there. It was like, there's these package, and there are a couple of buildings in Atlanta and Colorado Springs and Houston and different places. And so it gave us the confidence once we did it once or twice, like, we could actually pull this off,
expand into different territories, and now you're all over the country. I mean, talk to us about the different regions you're in versus DFW. I mean, DFW's home base, but you've certainly done, I would say, probably a big chunk of your transactions elsewhere now.
Yeah, I feel like we see so many Texas developers and operators who are strictly Texas.
Totally,
that's a very Texas rule.
Yeah, we're Texas only, or we're Sunbelt only,
and so forth. There's a lot to do there. So we're in about 15 markets today. We've been in about 30. So some that we've been in and out of. Yeah, we love Dallas. We love Texas. I would say we've had trouble the last few years investing in Texas. We're underallocated in Texas and in Dallas.
Is that something you want to change?
Yeah, I've been trying to change it. It's just that, sometimes I feel like maybe we're a little guilty of knowing too much.
Yep.
And people from other markets come in and they're willing to pay more. And I'm not saying they're wrong, but at the time we feel like, no, we can't pay that.
Right.
So
right. It's gotten hot for sure. It's gotten very frothy
in every sector.
Right.
Every product type.
Yeah. How do you compete with a California owner who sees 150 a door and thinks that that's a steal for something that's
it?
Yeah. Last year was trading for 120.
In a certain way, we've done that in some upper Midwest markets. So we're pretty heavy in Chicago, Milwaukee, Minneapolis, Columbus, Cincinnati, that whole region. And you talk to a lot of people in other parts of the country and say, why would you go there? It's higher cap rates going in, it's higher cap rates going out, but it's steady Eddie. It's been great, great investing for us. And so a little bit less competitive. I would not say not competitive because everywhere's competitive. Plenty of institutional capital, all those markets, especially Chicago. And I'm speaking mainly about industrial in all those markets.
So it sounds like you're weighted more in industrial now, more so than multifamily.
We're about 2/3 industrial, 1/3 multifamily.
Okay. I think you saw something that a lot of people didn't see. I mean, obviously industrial's gotten super, super hot.
Yeah.
What is it that you think you saw that others didn't when you first started really expanding into industrial product?
So as I was saying, when we started, I'd say right at the beginning, we were fairly agnostic, right? We were a deal shop.
Mm-hmm.
Some would call us deal junkies.
Yeah.
I called myself a deal junkie. And if it was a good shopping center, and we built shopping centers and we built warehouses and we built apartments, some of these mentors and investors that I had from Canada used to tell me, well, industrial is just where it's at in terms of, stability, less CapEx, sustaining during more difficult times. So we did sort of gear towards that as a result of first some people recommending that, but also then our own experience, seeing how the properties actually operated. And now we've been doing it more than 40 years, and there's plenty of others who have. But I would say our experience, our deep experience in the industrial space, has really served us well to understand, to your earlier point about which locations and which markets and which cities and distribution patterns way before any of this e-commerce and Amazon. I mean, that just gave industrial a whole other kick that didn't exist. But it was a great product type before then. And by the way, we typically do not own single tenant business. Amazon, I don't say this with any, anything pejorative against Amazon or anything. If we found a good Amazon deal, we'd buy it. But Amazon's not a tenant of ours because we typically own multi-tenant buildings. We have some single-tenant buildings, and many of them we've acquired in portfolios. Some of them we'll sell, some of them we'll keep. But it's usually a multi-tenant play, and it's usually infill, right? So you're not going to see us way out in the burbs where there's a lot of land. You're going to see us near airports, on highways, in major industrial parks. That's kind of been our play right from the beginning, and it's worked well for us. And I'm a big believer. So now people call that last mile, shallow bay, infill, light industrial. I mean, pick your name, right? There's a lot of different
names. They use them all
all
interchangeably often, don't they?
But when you go, and I get these calls and have many different meetings with institutional investors from all over the world. We have investors from 12 different countries. When you first start talking to somebody and I don't want to pick on any one country, but somebody outside of the U.S. who's not yet in the U.S., and you start trying to question them or get their impressions or what are they looking for, you see the thought bubble of an Amazon building above their head.
Yeah. Lev is simplifying the most tedious parts of commercial real estate financing by bringing it all into one single platform. Use Lev to find new lenders matched exactly to your deal specs, manage all stages of your pipeline, and maintain relationships with your network. With Lev, you can keep in touch with your network, plus connect with over 7,000 active lenders. They're also just launched the newest version of Lev Memo, which uses your uploaded information to generate OMs with the click of a button. See how easy debt financing can be and why Lev users are launching over $3 billion in deals every month. Get started on lev.com today. It's name recognition. Everyone knows about it. It's expanding.
Right.
It's very interesting. Is there a niche in industrial that you see kind of being the thing right now? I mean, there's cold storage and there's, was it iOS? What are you seeing out there? What's really interesting?
So I hate that you say it's a hot thing, cold storage, and I don't even really want to talk about it, but we are doing cold storage.
Okay.
Yeah, we've done cold storage for a long time. We're big believers in the space. Most of what we have been doing up until now has been buying existing cold storage buildings and converting dry space to cold storage space within existing buildings. And that's done well for us. The problem is it's really hard to buy. There's not a lot that trades. Most of the cold storage buildings in the U.S. are owned by the users themselves. Most of the cold storage buildings in the U.S. were built before the year 2000. So now they're more than 25 years ago.
Yeah.
Most of the product that we've owned has been even significantly older than that. all that leads us to think that there's a market for building new cold storage. So we just acquired a piece of land in Dallas to build cold storage on it, and we're working on putting that deal together.
Interesting. I imagine, you mentioned most of them are used by the owners. So do you often find deals in sort of sale leaseback scenarios just to free up liquidity for some of these owners, or not so much?
No, a lot of, think of, a lot of the big companies, even the Walmarts of the world, with all their grocery stores, they need cold storage.
Yeah.
Everybody needs cold storage. The amount of, and the uses, it's really interesting. Ripening rooms for
you never think
bananas
about this. Yeah.
Avocados, right?
Yeah.
All kinds of food prep. Flowers, chocolates.
Yeah, flowers. Alex is a big flower guy, so it's his hobby. He collects flowers.
Flowers.
Yeah. Stupid. It's crazy. You don't think about all these things that we use every day, and yeah, you're absolutely right.
And again, COVID just accelerated that, right? So we all want more food choices, better food, quicker. So that means closer to you.
Yeah. By the way, do you remember how big bananas were during sort of the COVID coming out of it? Just how many, apparently bananas take up more weight than any other sort of commodity out there. Do you remember reading this?
No.
Yeah, I'm not making this up, I promise.
I think you might be.
No, that's apparently bananas are just bonkers on how much
you might be making this up.
space they take up and how much weight. Anyway, okay.
Well, also you can't put weight on them, right? So
Yeah, that's right. Exactly. You can't. Otherwise, you'll have smushed bananas.
Yeah.
So that's no good for anyone.
No good for anyone.
Okay, so we talked about industrial. Let's talk about a bit about multifamily, which is something that's near and dear to my heart. You're very active in multifamily, or traditionally have owned a lot of multifamily. Where do you see that space right now?
It's been difficult the last few years since the whole interest rate climb. So, rent growth was tremendous for a few years. Cap rates, were going down. Created an incredible opportunity. A lot of properties changed hands. We were fortunate that we sold a bunch of deals on the way up. We decided to prune the portfolio. And many people got caught floating rate debt.
Right.
We've had some of that too, where deals were in transition. So we've had some, pay downs on some loans that we've had to do. But that's the worst of it. I would say we didn't fortunately get ourselves in a position where we bought a bunch of deals that absolutely made no sense. We didn't use preferred equity or mezz on any of those deals. It's just not something that we do.
And usually fixed debt?
Usually fixed debt, but the exception was when you had a deal in transition that wasn't eligible or a candidate for that. So, but yeah, it's more been the story, I think, of, yes, your interest rate was tough to handle, but the rent growth has not been as good. So I think, those of us who've been around doing it for a long time, just like, you just gotta stick it out for a while. We're not yet seeing that rent growth come back. I really do believe that we will. I think that rates coming down a little bit will certainly help. Construction has slowed down in most places, though Dallas and Houston are pretty good at keeping up with a significant pipeline. But even that product in Dallas and other places like Houston are more concentrated. You're not seeing it everywhere in the Dallas area, for example. So I think that if you look across the country, we're underserved. We don't have enough multifamily in the country, and the demand is so much greater than the supply. I think we'll see that come back in favor of more stable economics for multifamily, and with the at the same time with rates mitigating a little bit. So
that's something we hear a lot, but it's so pocketed right now, especially right. There was such an overweight to the Southeast. Texas obviously got a ton. I think Nashville at one point early on,
a year or two before COVID, and then following a year into COVID, they had a multifamily boom, an office boom, an industrial boom, and then it seems like they're not even in the conversation anymore.
Right.
And Nashville, like Austin, they're great markets, and we like them both, but they're both small markets, right? Compared to cities like Dallas and Houston and Atlanta and Chicago and whatever else. So I think sometimes people get more affected by, they're looking at graphs and they're looking at percentage increases, or Denver even, without thinking about absolute numbers.
Yeah.
That's the problem, I think, with some of those markets. Not that they're not good markets. We like them all. But I think you have to take off your lens coming from a larger city when you're going to some of those smaller markets.
Yep. No, I agree. It's a good point. Tell us how you're structuring some of these deals. I mean, how are you capitalizing most of them? And do you do JVs, or you co-sponsor anything? Or
So we don't have a fund. That's not our model. We've never had a fund. We do deals 2 or 3 different ways. Deals that require more than, let's say, $20 million of equity, we do with institutional partners. So pension fund advisors, life insurance companies, fund managers of one sort or another. Sometimes those are part of what we call programmatic joint venture. So we have, an agreed upon allocation of capital from an institutional capital with a business plan to go out and source and buy and operate real estate. Deals that take less than 20 million of equity, back to what I was saying earlier, we have what we call our private capital silo, friends, family, high net worth, family offices, where we basically syndicate and find deals that we like and underwrite them. And we're fortunate enough that we have, following for a long period of time, but we're able to do those deals. So that's generally how we do our deals.
You always, it seems like you're mostly on the direct ownership side. Do you play in the credit space at all as well? Not really, no.
Okay.
Have you thought about it, or diversifying?
We've thought about it, but there's a number of things we've thought about, and then I said we're, industrial and multifamily. We used to, as I was saying, do a lot of different things, retail and office, and I'll come back to office. We decided, maybe 15 years ago or so, to be a lot more focused and disciplined. So that's the primary reason, is to stay focused and disciplined. Except when you get excited about something and then you decide to change your mind and throw the
So what's an example of that?
Office in San Francisco. So because I'm in the Bay Area, I see really a historic opportunity. San Francisco, like New York, is one of those places that, in my view, you shouldn't bet against. We're actually spending time looking at office buildings, and we've offered on a couple, haven't been successful yet. But if I had to guess or hope, I'd say that we'll probably be buying some buildings over the next year or two.
Interesting. I hear San Francisco is coming back finally, or I don't know. You see the headlines in the news. I don't know if it means much.
I think for those of us who are there and follow it closely, we clearly think it's back. And there's a lot of support for it, right? Talk to the leasing agents; they'll tell you that they're as busy as they were in 2019.
Yeah,
there's lots of leases, and a lot of it is AI, but San Francisco is the center of AI, and here too, I think is
the funny thing about AI is tech. You think they don't have to be in the office as much, but these AI companies are demanding everyone to be in the office.
Well, that's the other thing that I think drove it, is that finally the big tech companies made those decisions to tell everybody they need to come back. The other thing with San Francisco is the homeless and problems and other things associated with are really ridiculous, pitiful, shameful, shouldn't be anywhere, and it shouldn't be in a city like that has so much to offer and so much wealth. It's really a leadership problem. We have a new mayor. People are, I think, quite encouraged. I'm also encouraged. He's done thus far a good job. The job is not finished. He's got a long way to go, but he's off to a good start, and I think people are feeling very supportive and willing to help. He's raised a lot of money privately to do things not on the shoulder of the city and the state. He walks the property. He walks the areas, with a team, and then comes back a day or two later to make sure it got done. I think he's a smart guy, and so fingers crossed.
That's great. You don't hear that often of people just saying positive things about leadership in cities like that.
No, not today. Cliff, seeing that story in New York early on, right, where once the tenants came back, they're very selective, looking, we always hear flight to quality. Now that has been stretched 50 different ways. Now that San Francisco is coming back, we've seen it, parts are already definitely back. Where is it? What part of the geography is it hitting first? Because San Francisco is a very spread out city. There's tons of neighborhoods. It's like 2 or 3 times that of DC, right, where it's very pocketed. What gets you hopeful in that market? Which areas?
So the Bay Area, right, is I think really interesting. It's 9 million people, and it's San Francisco, Oakland, and San Jose, right? 3 big airports, huge, as you say, geographic area. And I think they all have opportunity, right? So Silicon Valley, East Bay, and San Francisco. We're focusing right now on just San Francisco. I think there's other opportunities that we'll consider over time, but to get going, we want to focus just in the city of San Francisco, which is a lot more focused. And I think at the end of the day, we'll see the greatest results. I'm also a big believer in Silicon Valley. There's lots of really interesting things going on there as well. Within San Francisco, then
it's still very spread out.
Correct, right? So we're looking at the financial district, and even then you break it. It's almost of block by block, right? And or Union Square, if you think about, 2 blocks away versus, closer to Union Square, it gets choppy. So I think you got to be careful. The real hot areas are Jackson Square, where huge rents and a lot of marquee sort of investors and users have bought property there. Soma, south of Market Street is pretty interesting. The sweet spot for a lot of these AI type firms is really quite small. For the VCs are backing everybody, right? If you want VC money for anything but AI today, you're probably going to maybe medical you'll get some, but it's really about AI. And so they're throwing money. And a lot of these companies, I'm hearing, I toured a bunch of buildings last week with various leasing people. And what they're saying is that the thickness of demand is in this 5 to 20,000 square feet. There are some larger leases, but
it's very flex.
It's very, and they're saying, they walk the space and they'll say, "I'll take it, and I need to move it next week."
They move quick.
It's really that kind of thing, right? So, the landlords that are being successful are the ones that have the spaces ready and actually with furniture even.
And it's all AI driven mostly?
A lot of it's AI driven. Yeah.
All of a sudden, it doesn't seem like such a bad idea to call WeWork and get them back in the buildings.
Right. I know you have a lot of thoughts. I don't need to speak for Alex, but he's got a lot of experience in the office space, also in San Francisco. I know you were involved in the Transamerica.
Yeah, I mean, San Francisco itself is a really interesting market. I've always... you compare the 2 biggest gateway cities, New York and San Francisco. Everybody likes to make it sound like it's New York, LA. LA's never been the case. They don't have much of an office market. You have to drive 2 hours.
I never
across
think of LA as an office place. That makes
Century City.
Yeah, Century City.
Downtown has been a disaster in the office side.
San Francisco is much easier to get around. If you're in LA and you live in Santa Monica, you can't have an office in West LA. It would take you a day. It's a crazy drive.
Right.
Yeah. So
you're in Santa Monica. So why would you?
Each neighborhood has their own office market. So it's easy to compare New York and San Fran. Mm-hmm. New York kind of has a cheat code because we have a grid. So it's very easy to identify what the neighborhood is, and I can do it, almost by the square foot because I say 42nd Street to 59th between Park and 5th.
What's the walking distance from the train station, from the commute station?
Yeah. Right. So and that the kind of the meaty part of that bell curve is probably in between 42nd and 59th, where it's the closest to get. Anyway, so where I struggle with San Francisco is you're right. It's such a block by block difference right now. So I'm curious, as someone who's not there, where everybody is flocking to. And to your point, it's a lot of activity, but the volume isn't necessarily there because it's 5 or 10,000 square feet and such a dense office market.
But it's not just, by the way. That's where a lot of it, and we're looking at some smaller buildings as a result of where we see all that demand is. But also, there's 2 new buildings that have been announced, right? Related is announced one, and Hines is brand new buildings, right? Big high towers. So there's the big guys, and big tenants too, are also active.
Now those new projects, and we had Owen Thomas, who's chairman of Boston Properties, on recently, and it sounds like these new mega projects, they don't get done until you already have a tenant who's committed. So I guess for that Hines project and related project, they already kind of know who's going to fill that up.
Yeah, I don't know if they've announced any pre-leasing, but they both announced, the sites they control and own, and so
it must take pressure. I mean, it's going to put a lot of pressure on those other owners, right? I mean, I know in New York, Hudson Yards has crushed it, right? I mean, it's certainly one of the places to be because it's the new shiny thing and it's fully amenitized. And I don't know. Am I wrong?
Yeah, I don't know that Hudson Yards is where everybody's flocking to, but my opinions on Hudson Yards is let's table that for a second.
Buildings that are amenitized. That's what's getting attention, because in order to attract people to go back to work, you need to offer them something.
Yeah.
The news is important, but if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free.
But in San Francisco right now, because the overall story hasn't improved so much, how's the financing looking?
For new development?
For existing or trends.
A year ago, 2 years ago, there was no debt.
Right.
It'd be interesting. I'm a member of Urban Land Institute, ULI, and a council. 2 years ago, when we had people put up their hands, who's interested in office, there was a couple of people kind of
looking around the room,
literally.
You get executed for that.
Yeah, exactly. You're like, what are you, an idiot?
Office?
And then last spring actually, there was a bunch more people, and now it'll be interesting that the meetings in San Francisco in October. So I'm really curious to see. Yeah, it's going to be. But just from talking to people, there's debt available. Now it's not, but you don't want to put a lot of debt on these buildings anyway. But
of course, but if you have to underwrite 20% vacancy factors and you have to underwrite, rents that are half of what you can get because the building is so highly contested. So it's an interesting time. But I do agree with you. Whoever can figure that out, and maybe it's all cash buyer, and then you figure out how to lever or whatever that situation is, you're going to be a winner.
Well, I'll mention two quick things on that. There's already been a lot of trades. And the people that have bought buildings have, for the most part, leased up and done, not necessarily leased up to full occupancy, but leasing activity has been good. And so the market has given support to the people who came in early. They took a lot of risk and they deserve to be rewarded, but they did. And so I think the jury's kind of back in, and I don't think it's going to last forever, but you're buying at prices close to what those buildings were trading for 20 years ago.
Right. Wow. It's pretty crazy.
It is.
Pretty crazy. I mean, that's, similarly to multifamily right now. I mean, that's the same thing. The narrative's been below replacement cost. You can pick this up below replacement cost, but it's more than that. I'm seeing deals that, are trading at 40% discounts.
Replacement cost doesn't make sense today. You can't.
Right.
It costs you $2,500 to $2,700 a foot to put up a brand new office building in New York. You need average rents in the building of $280 a foot or $270. Like, so replacement cost is no longer relative.
Even garden style, like multifamily in Texas.
But with the multifamily, the problem has been with interest rates a little bit higher and the prices that people were willing to sell those properties for. Mm-hmm. You had to rely, in order to come out on that deal, because we've tried to buy a bunch of these deals where they were well below replacement cost, you had to rely so much on later year rent growth that it's like...
That's a scary thing.
It's a scary thing.
It is bonkers. I mean, you're absolutely right. I mean, the deals that are getting done, particularly in the Class A space, right? It's 4 or 5% rent growth in year 2 or 3. Which, I believe in it, but I drink a lot of the Kool-Aid because, we're in it.
You make a living doing it.
That's right. Exactly. So anyway. Are you seeing multifamily penciling, though? Are you starting to see it come back in your portfolio?
It's been 3 years of really tough economics in the multifamily space. We still believe in it, but we're sometimes maybe guilty of being too conservative and missing opportunities. But so, people might look back and say, well, you should have bought every one of those deals that was, well below replacement cost, because that rent growth story, when you look at the lack of starts on the construction side, is turning out to make sense. But it's hard at the time where when you're sitting there trying to say, well, I'm not getting much cash on cash. If anything and then we didn't even mention the headwinds of increased taxes and insurance, or what other weird stuff's going to come up to hit you that takes away your rent growth in year 4 or 5.
Right. We were spoiled, right? I mean, for a few years it was just cap rate compression.
It seems like that's the case across all real estate at this point. It's like they've found ways to decrease your cash yield. They found ways to, between exactly what you said, taxes, whatever. There's a boom in almost every sector, so you're killing rent growth.
Yeah.
I don't know what's left. Maybe some appreciation. I think it's just natural inflation is all that's carrying real estate, or at least it feels that way for the last few years.
Not to say, at what point do we hit a recession? Forget about politics. We haven't even talked about politics.
Right. Yeah.
2 wars going on, and event risk. Right.
Yeah.
So you got event risk. You got the fact that we're long in the tooth in this economy. At what point does that?
And that's going to impact your collection loss.
Correct.
And,
so all of that is when you're factoring in, well, okay, am I going to make? I love this asset. I like that it's whatever percent below replacement cost. And here's the other side of the ledger with all this stuff stacking up against why that still doesn't feel great.
Yeah.
When you're buying it at a 4.5 cap or something.
So, yeah, totally. No, I totally know what you're talking about. Yeah. And I think people are starting to, investors are starting to become a little bit more concerned about that for sure. I mean, on that note, do you see advantages right now playing in the more new development sort of Class A space, or will you play in the workforce housing?
We've morphed more towards trying to buy a newer product in this economy, because you look at it and you say there's not such a huge price difference.
I know,
and return difference for sure between 2000 and 2015 or 20.
Yeah. What's the difference between buying a 5 cap and a 5.5 cap? I'm just using it as an example when it's like a 90s vintage deal versus a 70s vintage deal. I mean, one would expect more of a premium spread.
And even that 2015 is 10 years old. Those units need to be redone.
Yeah, right.
So it's tricky.
Right.
Well, anyway, Cliff, it was great having you on. It's awesome to hear about Dallas, which I know I'm not familiar enough with. So it's good. It's good to get a very on the ground, real perspective, and excited to hear all the other stuff you're working on. Maybe we'll see you in San Francisco in October.
Let's hope so. Let's go to San Francisco.
Yeah. Well, I don't think you.
I'm cool enough.
Cliff and I got a handle.
I'm fine. You're not coming to Dallas. Tell us, on a positive note, where do you see the market headed? What are you most excited about?
Or on a negative note, whatever's really
I'm a glass half full type of guy.
I'll hit you with both.
Okay.
So the business is a lot more competitive than it ever was, right? In this environment, trying to secure capital, equity, debt is becoming a lot more plentiful than it was a year or two ago, but equity is still really tough. So I would say it's a lot more competitive. From that point of view, a little bit less fun. But I think it makes people smarter, better investors in an environment where capital is not so easy to get. So I think that part is maybe mixed. Having said all that, I'm a believer, right? I think that if you buy sound real estate with underwriting that doesn't fool yourself, whatever the product is, and especially I think, industrial, we're big believers in industrial. So, we're not folding up the tent. We're still active. We're still growing. We're still hiring. We're moving into markets. We have a property under contract in Reno. We've never been in Reno before. It's a market we've studied and tried to offer for a long time. So just as an example. So I think it's both, right? But I guess the word for me, or that I tell myself, is you got to be careful. You got to be careful because we cited all these headwinds a few minutes ago related to multifamily, but it really applies to everything. Mm-hmm. And I think that sometimes I see when we lose it, we like to do a postmortem. We ask our guys, okay, talk to the brokers and say, well, why did we lose that deal? In other words, underwriting was how were the group that won that deal, how did they underwrite it? And then we look and say, well, maybe they have a little bit lower cost of capital for us. Yeah. Okay, that's fair. But really, when they look and they say, well, they didn't underwrite, new roofs, or they thought rent growth of this, and we're going, that's,
then you have it yourself.
Go for it. Yeah.
Yeah.
So I think it's a cautionary tale for us about, there's AI, yes, but at the end of the day, the basic stuff in real estate applies.
Yeah.
End of the story. And just sort of don't lose your head, and don't try and get ahead of your skis. And the thing that I've learned maybe most is debt. Most times where people get in trouble in real estate is debt. Yes, weird things can happen, but most of the time it's debt. Even if you look at the crash, 2008 in New York, the height of the crash, and Bear Stearns, Lehman, everybody, who got hurt here? Who lost office? But the people who unfortunately had debt maturities within a 2-year period.
Yeah.
If you didn't have debt maturities within that period of time, you're probably okay.
Yeah. Yeah.
So that's the thing it's about not over leveraging.
Yeah. Okay.
That's a good note.
It's good advice for sure.
I'd love to hear it.
On that note, thanks so much, Cliff.
Yeah,
Thank you,
thanks
guys.
again.
Enjoyed
Great
it.
to meet you.
Appreciate it.